Welcome to Dr. Fred Markets. This is not financial advice. While most people scroll past the noise, a few take the time to understand what's really going on. Finance, crypto, artificial intelligence, this is where it all connects. You made the right choice being here. Let's dive in.
Your holy pastor is about to sell you private credit. Signal 1. Private credit has exploded from under $500 billion in 2015 to over $2.1 trillion today, outgrowing the entire hedge fund industry while you were doom-scrolling politics. Signal 2. Religion-linked nonprofits in the U.S. now control an estimated $1.5 to $2 trillion in assets, and the fastest-growing segment of their income strategies isn't tithes. It's outsourced Wall Street-style lending products marketed as values-aligned impact. Signal 3. At the same time, private credit funds charge fees up to 2% management plus 20% performance on illiquid loans to over-leverage companies, while regulators admit they have almost no visibility into the risks building there. So why are faith-based investors being steered straight into that black box? Here's what's happening today while you argue about elections and religious freedom on Twitter. Institutional religion is stealth merging with one of the riskiest corners of modern finance, and your belief system just became a distribution channel. OpenAI gatekeeps its new model to Trump-approved customers. Trump's crew wants a religious liberty commission that blurs church and state. Meanwhile, the real action isn't censorship, it's product placement, finance products in pews. The mechanism is simple and brutal. Church donations and religious endowments chase safe yield in a zero-rate hangover world. Banks pulled back lending after 2008 and again after 2020. Private credit funds walked in and said, "We'll lend. You get 8 to 12% with value screens. Sign here." They wrap high-fee lending in moral language, supporting Christian businesses, defending religious liberty, family-centered entrepreneurship. Translation: you're funding risky loans to mid-sized firms that banks didn't want, but with a hymn playing in the background. You will not hear the real risk pitch from the pulpit. You'll hear, "We're partnering with a faith-based investment platform so your savings work for God." The platform then allocates into private credit funds and structured notes with disclosure documents longer than the Old Testament and about as readable as Leviticus in legalese. Why private credit? Because it's perfect for this game. Opaque. No daily pricing screaming down 30%. Illiquid. You lock in money for 5 to 10 years while managers collect fees annually. Narrative friendly. Banks discriminate against religious organizations, so we fund them directly. Look at the timing. Geopolitics heats up. US hits Iran after a drone strike on a commercial ship. Defense risk up, oil risk up, shipping risk up. In unstable times, yield-hungry investors crave uncorrelated assets. Private credit sells itself as exactly that. Politics turns to religion. Commissions, lawsuits, religious liberty everywhere.
Does what you just heard make you want to learn more, to dig deeper, to ask better questions? That curiosity is exactly what separates people who understand finance from those who don't. Most people stop at the surface. You're going further. Let's continue.
Institutions that speak in God's voice now get shoved a fresh script from Wall Street. Protect your flock from woke finance. Use our values-based lending vehicle. The 3 signals line up. 1. Religious assets are huge and under-monetized by Wall Street. 2. Private credit needs fresh meat for its loan machine as competition rises. 3. Political religion is the perfect marketing wrapper to move complex credit products as identity badges, not risk decisions. The truth no one on CNBC will say: your faith community is becoming a high-yield bond desk with incense. Here's the one thing you learned today. Values-based investing is not a moral category. It's a distribution channel. The underlying engine is the same leverage, same risk transfer, same fee skim as any other private credit fund. The cross is just better branding than a Bloomberg terminal. Mechanically, here's how it pays the street, not you. You invest in a faith-aligned income fund. That fund buys slices of private loans at, say, 11% yield. Manager takes 1.5 to 2% management, plus up to 20% of returns. After defaults and recoveries, your net might be 5 to 7% if the cycle doesn't turn hard. If it does, you're still locked in, and you find out those loans weren't conservative Christian entrepreneurs, they were highly levered HVAC roll-ups in Ohio and an MLM-adjacent family wellness chain. What does this mean for you? You are not just a believer, you're order flow. The question is whether you act like it or not. 3 actions. 1. Demand the X-ray, not the sermon. Ask any faith-based investment pitch 3 questions. What exact asset class is this? Private credit, mezzanine, distressed, etc. What are the lockups and redemption rules? Show me default rates and realized net returns, not target yield. If they can't answer clean in under 60 seconds, walk. 2. Separate belief from basis points. Tithes are charity. Investing is math. Never confuse them. Give to your church as charity. Invest your savings with one rule. If the risk-return profile would stink without the religious label, it still stinks. 3. Front-run the next wave. Regulated transparency. Private credit sits in the regulator's crosshairs next cycle. There will be a blow-up. When that happens, faith-based wrappers that survived with real underwriting and low leverage become interesting because they'll be the few who weren't just doing moral theater. Build a watch list of boring, transparent vehicles now. You want audited numbers, not inspirational taglines. This is not financial advice, but here is the truth. Your faith institutions are entering the most aggressive lending boom of your lifetime. Decide today if you're the lender, the product, or the cleanup crew. This is not financial advice. If you enjoyed this video, please subscribe to the channel and check the links in the first comment below.
That's a wrap for today on Dr. Fred Markets. I hope this gave you something to think about, a new angle, a clearer picture, a better question to ask. Remember, this is not financial advice. Do your own research, always. If this video added value to your day, subscribe. It's free, it takes 2 seconds, and it's the best way to support this work and keep it free for everyone. You'll also find every video as a full article on the blog, drfredmarkets.com, and the newsletter is in the bio. I'm Dr. Fred Markets. See you in the next one.